Ladies and gentlemen, good day and welcome to the TCI Express Limited Q2 FY23 conference call hosted by PhillipCapital India Private Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on the date of this call. These statements do not guarantee the future performance of the company and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikram Suryavanshi from PhillipCapital. Thank you and over to you, sir.
Thank you, Inba. Good evening and very warm welcome to everyone. Thank you for being on the call of TCI Express Limited. We are happy to have the management with us here today for question and answer session with the investment community. The management is represented by Mr. Chandra Agarwal, Managing Director, Mr. Pavitra Panda, Chief Operating Officer, and Mukti Lal, Chief Financial Officer. Before we start with the question and answer session, we'll have opening comments from the management. I will hand over the call to Mr. Chandra Agarwal for opening comments. Over to you, sir.
Thank you. Good evening, everyone, and welcome to the Q2 Financial Year 23 earnings call of TCI Express Limited. I would like to thank you all for joining us here today. To start with, I will give you an overview of industry and business for the quarter, and then we'll hand over the call to our CFO, Mr. Mukti, to brief on the financial performance for the quarter. Our earnings presentation has been uploaded on the website and stock exchange, and I hope you've had a chance to look at it. The first half of financial year 23 continued to see recovery in overall macroeconomic scenario, guided by strong government initiatives to stimulate the economy. The trend was visible in many economic indicators like index for industrial production, GST collection, stock market indices, and report from external rating agencies. During the quarter, we saw an overall improvement in the output for the month of July, with marginal decline in August, primarily due to decline in manufacturing and mining sector. The e-way bills generation is another factor that indicates the performance of the logistics sector. Overall, the e-way bill generation for September ended up on a strong note, reaching 7.6 crores, driven by ensuing festive season demand at a growth of 152% over pre-COVID period. Given this strong economic environment, the logistics sector continued to experience a recovery trend. TCI Express, being the market leader in express trucking logistics, delivered the highest quarterly revenue of 312 crores, registering a growth of 13.2% year-on-year and 6.8% on sequential basis. The top line growth was primarily driven by the SME customers, higher volume across services, automation of the sorting centers, also substantially increased the daily capacity by reducing the parcel holding time and the labor involvement, resulting in enhancement of complete operational efficiency and strong sustainable margin. EBITDA for the quarter was 54 crores with a strong margin of 17.2% as compared to 15.3% previous quarter. The EBITDA margin growth was primarily on account of higher capacity utilization and operational efficiencies. Coming to business update, during the first half of the year, we have incurred a total capex of 50 crores, which have been primarily spent towards the purchase of land in Calcutta, the native sorting center, and also network expansion by adding 22 new branches to serve growing market. The automation and digitization will enable us to be much more efficient and in continuation deliver superior customer experiences to enhance also the operational efficiencies. By leveraging our asset-light structure with automation and digitization, we continue to enhance a competitive position as a leading provider of express services. Our newly launched services are also growing strength to strength, and we expect these services offerings to contribute productively to the top line in the forthcoming quarters, enabling us to deliver higher margin levels. From a balance sheet perspective, we continue to maintain strong capital structure, providing us the financial flexibility. We continue to focus on balanced capital allocation and strengthening of our network. In view of a strong performance in the first half of the year, I'm pleased to announce that the Board of Directors have recommended an interim dividend of rupees 3 per share with a payout of 150% on the face value. Looking ahead, the industry remains poised to grow strong as the growth of the logistics sector is fully aligned with India's economic growth potential. With major policy push aided by the strong economic recovery, we remain confident in our ability and our superior product offering. We will further help us benefit from the upcoming growing opportunities. With our customer-first focus and innovation-driven asset-light business model, we remain confident of our superior value-added services to retain our leadership position. With this, I'd like to hand over now to Mr. Mukti to talk about our financial performance for the last quarter. Thank you.
Yeah, thank you, Chandra sir. And now I would like to discuss the financial performance of the company. And during the last quarter, our revenue from operations stood at rupees 310 crore for Q2 FY23 as compared to 290 crore rupees in Q1 of FY23 and 273 crore in Q2 FY2022. The total income for the quarter was 312 crore as compared to 292 crores in Q1 of FY23 and 276 crores in Q2 FY22, translating into a sequential growth of 7% and 13% year-on-year basis. This significant growth is attributed to multiple factors like growth in demand from SME customers, improvement driven by automated sorting center, higher capacity utilization, increased demand from rural areas, and festive seasons. So overall, the total income for the first half of the year is 605 crore as compared to 500 crore last year, posting a strong year-on-year growth of 21%. We witnessed a strong improvement in EBITDA and margin as well, and the EBITDA stood at 54 crore rupees with margin of 17.2% in comparison of 15.3% in previous quarter. So I am happy to report that for the first half of the year, our EBITDA is around 98.5 crore rupees as compared to 81 crore rupees in the same period of last year. So the net profit for the company in Q2 is 38 crore rupees with a robust margin of 12.1% as compared to of rupees 31 crore and margin of 10.6% in Q1 FY23 and rupees 34 crores and margin of 12.3% in Q2 FY2022. Overall, the net profit for the first half is 69 crore with a margin of 11.4%, registering year-on-year growth of 19%. As far as our future focus is concerned, we will continue to invest in technology and investment automation to drive a more efficient operation and provide a superior customer service. We invested a capex outlay of rupees 50 crore during the first half of the year towards the above. The ongoing automation and digitalization which will enable us to be much more efficient in delivering superior customer experiences and enhance operational efficiency in the long run, which enable us to deliver industry-leading performance. By leveraging our asset-light structure with automation and digitalization, we continue to enhance our competitive position as a leading provider of logistics services. So going by the festival demand trend and government's push in improving the overall connectivity across the country, I am highly optimistic of higher capacity utilization and better consumption from our new offerings like better contribution from our new offerings like Pharma, Cold Chain, C2C Express and Rail Express. The impact of these changes will be reflected in our financial performance in forthcoming quarters. So now, thank you very much, and now I would like to open the floor for question and answer. Over to you, moderator, please.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Any participant who has a question may enter star and one. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amit Dixit from ICICI Securities. Please go ahead.
Yeah, good evening everyone and thanks for the opportunity. I have a couple of questions. The first one is on the tonnage. What was the tonnage in Q2 FY23? And the second question is on working capital. So net working capital days, if we see they were higher in this quarter, possibly due to higher receivables. Do you see the possibility of this reversing? And if so, what could be the net working capital days by the end of FY23? These are the quick questions, sir.
Yeah, well, so tonnage numbers in this quarter for this quarter is 2,47,000 tons, and in half year it is 4,77,000 tons. And second question, you asked for the working capital days. Yes, that has increased by almost 9 days, and it is a very temporary because what happened in the last month of this quarter was the highest revenue we have achieved. That's why there is a just temporary impact on that. And another aspect of that, in sundry creditors, we have paid some vendor on early or due to this festival season. So one schedule we have made on some early payment to them. So that's why it's just like a temporary impact in sundry creditors days and debtors days. So it will be normalized, and I think in Q3 it will be normalized back to kind of like 48 to 50 days in a receivable days and 35 days in creditor side. So net working capital cycle will be back to 14 to 16 days.
Sir, basically 29 crores I think was locked up in receivables in this half year. So you are saying that as the year goes by, this also will be normalized.
Yes, this will be also normalized. It may be like you rightly said, this is an increase by 29 crore. It may be increase of like by year and maybe 10 crore or 15 crore max in overall basis.
Okay, wonderful. Thanks and all the best.
Thank you.
Thank you. Our next question is from the line of Alok Deora from Motilal Oswal. Please go ahead.
Good evening, sir, and congratulations on great numbers, especially on the margin side. Sir, just wanted to understand on the volume trend, how it has been and how is the festive season shaping up for us. Looking at the numbers, it seems has been pretty good. Just because in some sections of the logistics segments, we have been hearing of some slowdown in September. So just your thoughts on that.
Yes, Chandra, sir.
I don't see there's a slowdown as such compared to other sectors. But in general, the economy is doing quite well. And in fact, most of the sector verticals that we are in, we have not seen any sort of like a complete slowdown or anything of that sort.
Sure. And also, just wanted a sense on how is the Gurgaon, sorting center has been coming up because I understand that first couple of quarters after the commissioning would have been more of a, testing period type. So just how has the feedback been and
so coming up, so it is already up. It is up and running. We've already done the maximum. The impact has already been seen of labor reduction, of trucks. The time it takes for the trucks to, it used to take earlier, the halting period. But this has to be now extended to other locations to really get another, set of benefits coming in. So, if you look at location A, B, and C, if you only do this from location A, and then you don't do it in B, so you get only half of that benefit. So it's very imperative that we do that location B also going, so that, if the vehicle is halting, say, 24 hours on each side, and then that means it's like almost 48 hours. Then and we were able to reduce it to 8 hours. So we had a substantial saving right there and then. So that sort of benefit will come as we keep going further into expanding automation into other sorting centers. This Gurgaon has been performing really well, and I invite all of you, whoever can visit, please plan, and so you can really see what we are talking about.
Sure. And just a last question. So, how are we looking at deploying the automation at other centers like Pune, and how are we going to replicate that to other centers? Any update on that, or any strategy we have formed for that?
So our goal is to cover 10 or the major 10 to 11 in the next 4 to 5 years. And of course, the learning curve comes down with every sorting center that we build, that we automate, But the bureaucracy with the land and with the land acquisition and all of that is something that takes its own sweet time also. So, and then of course there's construction. Like our Gurgaon sorting center was slowed for 2 years unnecessarily because of the pollution norms, and construction has been halted again in New Delhi. So I think in Gurgaon area. So I think these sort of challenges are, it's always going to be here in India, and we have to deal with that. So looking at that, I think the 4-5 year plan that we have is kind of like quite all right to achieve it.
Sure. Just last question. So these margins of 16.5%, 16.6%, that's how are we looking at that in the second half? Would it be at similar levels, or could it further improve from here?
It will 100% further improve, and there is no denial in that. I mean, it has to be always, there is no reason for it to come down, because, like as I mentioned, the economic conditions and everything, albeit the inflation, everything seems to be in order, and with that, there's no reason for the margins to come down.
Sure. Great, sir. Thank you very much, and all the best, sir.
Thank you.
Thank you. The next question is from the line of Krupa Shankar NJ from Spark Capital. Please go ahead.
Good evening, and thank you for the opportunity. Just a couple of questions from my side. First, on the automation front, Chandraji, you have mentioned that the turnaround time, of course, is going to improve with automation coming through new sorting centers. But with respect to margin improvement, so given that our trucks are paid or vendors are paid on a per kilometer basis, so the margin improvement, what would be the key drivers, if I were to understand?
Sorry, can you repeat last line, what you said?
So what are the margin drivers? So for example, you do highlight that the margins will expand because of automation, and that is more or less translating into a shorter turnaround time. So what are the key drivers, given that we are paying our vendors on per kilometer basis, so the turnaround time should not matter with respect to margin profile. So can you explain a little bit more detail on that front?
Yeah, well, so basically, as Chandraji has mentioned, we have the halting time right now in the range of 20 to 24 hours on both hands, like origin sorting center and destination sorting center. So supposing they're making a kind of like 7 trips in a month from particular A location to B location. Now we able to reduce their as now we have reduced the halting time on a location A. That means their trip will be increased in a particular month. So they will be saving on their fixed costs, like again driver salary and insurance and truck cost, depreciation, everything they will be saving, because and their inflow will be increased. So they will be whatever saving they will be have, they will be they are sharing with us like they have done in the time of where we increase the axle load in these trucks, and they whatever saving they have, because then they have shared with us. So same way we are doing for this one. This is the one aspect. Second aspect, obviously we also are able to reduce the labor component on these centers. So that is also a part of direct cost. So and it will be also reducing on that.
Right. Got it.
Which we are, apart we are enhancing customer satisfaction level, and it is a high turnaround time. So itself, high turnaround time is doubling the capacity of this existing center. We can be process the double triple cargo in the same center, by arranging or managing this speed of machine, because this now is completely automated one. So in a various sense, it is giving a high efficiency to us. You will be wonderful. We can be adjust the speed of this movement of cargo in this for that shorter. Supposing in a lean time we can be reduce the speed. In high time we can be increase the speed. So accordingly cargo will be processed on that. In this sense, it is giving a very good kind of efficiency in this system overall, in the part of efficiency improvement and also reduction in cost also.
So Mukti, so the order is right now Gurgaon is done, then next would be Pune, then followed by Chennai, and then I think can you just list down what are the key sorting centers which will be coming up in next 2 years, if at all? I mean, and commissioning itself by FY24.
Yeah. So basically, we are trying to negotiating for the now. We started the negotiation for Pune. Then it will be come for Chennai, Kolkata, Mumbai. These are the in line with. And obviously Ahmedabad. I think by 2025, 3 years down the line, we will be having 5 more in these 3 years.
Understood. And with respect to the load factor on the truck side, can you just elaborate what was it for the quarter?
So load factor in this quarter is 85%.
85%. Okay. And is there a guidance with respect to, or rather a revision in the guidance with respect to revenue and margin for FY23 and if at all for FY24?
So whatever guidance we have given in inception of this year, we are still on the same path. We will be certainly achieve 18 to 20% revenue for the full year. And same way, we are also looking for FY24. And obviously, we want to be enhance the margin level. So margin level in this year, we are planning to be have on full year basis 17.5, and then next year again in the range of 18 plus.
Understood. Thank you and all the best.
Thank you.
Thank you. Our next question is from the line of Sagar Bhatia from Prabhudas Lilladher. Please go ahead.
Hi, sir. Congratulations on these set of numbers. Quickly just want to deep dive into the code.
Mr. Bhatia, if you're on a speaker mode, can you please switch to handset and speak? Your audio is a bit muffled, sir.
Okay. Is this better? So quickly just want to understand the cold chain business and what margins are you looking at over there going forward for the next year?
Yeah. So cold chain business, we just doing the pharma cold chain business. We are not doing other businesses of food or other grocery item. We are not doing that. Other thing, we are also not doing the warehousing. We just doing the trucking. Refrigerator truck we are moving. So margin level in these trucks is also in the range of 18 to 20%, and we are doing for the only pharma customer. Next year onwards, it will be also the same. We are looking for the same margin level. Because again, if you see, we carry the this perishable item, we maybe not have that much margin, but we are just carrying these high value medicines, high value vaccines, everything we are carrying high value. That's why margin level we are able to interact to in the range of 18 to 20%. Other aspect of that, because we have the big branch network across India. So that's why again same way, we are doing in a surface trucks, we are able to fill these trucks back to also, supposing one truck has moved from Pune to Delhi, then again we have the cargo for the Delhi to Pune. So that's why we are able to generate the good margin level. And again, it is also same way, it is asset light model. We are not owning or not planning to own any truck on our balance sheet.
All right. That answers my question. All right. Thank you so much. That's about it.
Thank you. Our next question is from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Thank you, Chandarji. Really, you are doing fabulous and extremely well. Sir, our market share is 7% in India, which you show in investor highlight. Where we can see in next 5 years this 7%?
Thank you for your encouragement. Now, I can tell you one thing, that the market is so vast, and 7 to 10% is what we say. Now, with the new Gati Shakti policy coming up, this can easily go up to 15 to 18%. But the fact is that how do we determine that? Because government doesn't give the data for GST collection of 18% versus 5% and all that. So if you really see the expectation, of course, I mean logically, it would mean that we're getting market share. The larger the portion of the economy is becoming formalized, is coming into the GST and ambit, is when we will see our market share also increasing in the organized segment.
Okay. But you will not able to quantify, right?
See, it's very early because, we have to see, COVID just got over, the war just started, war is 1 year going on. And
sir, war impact is not on India at least.
But we are getting affected, right? By the high fuel prices. And that has also led to inflation, not just here, but globally. So right. It's only, and if India had not done the deal with Russia, then we would be looking at absurd prices, oil prices, and inflation. So there are multiple factors that we need to watch out for.
Yeah. And sir, in Q2, how much volume growth and how much price growth?
Mukti?
Yeah. So volume growth is in year-on-year basis was 12.5%. So price increase is hardly 1% of that.
Price is 1% only. Okay, sir. And in buyback, we are not offering any share in the market, right? Promoter?
So we are buying the share from the market regularly.
Yeah, that I knew. But promoter is not going to sell any share, right?
Yes, promoter is not participating in this buyback.
Okay. Thank you very much and all the best, sir. You are doing extremely well. Thank you.
Thanks.
Thank you. We'll take the next question from the line of Radha from B&K Securities. Please go ahead.
Hello, sir. Thank you for the opportunity and congratulations on consistent performance. So my first question was, so we have reported around 7% QOQ top line growth. So what are, I believe that auto, pharma and cap goods are the primary sectors that we deal with. So what are the underlying sectors that have shown highest growth in the demand?
So So Radha, you are right. You rightly said. So auto is a major contributor. Auto and retail sector, because this is a festival season. The pre-Deepavali month has gone. So retail and lifestyle product and electronic item, they are major contributor in that. And pharma is slightly kind of flat.
All right. So my next question was, I believe that in FY23 we were estimating to take around 3% price hike, and 1Q maybe we were not able to take. But how much price hike have we taken in this quarter, and how much can we expect more for full year?
So we have till time we have taken almost 1.5% price hike. And by year end, we are targeting to have at least 2.5 to 3% price hike for the whole year. That is, we are planning, and we have planning. So again, it is a very systematic process. These agreements with the customers is renewing in each year, rollover basis, annual basis. It is rollover, and wherever is come for the renewal, we are asking for a hike from the customer, and we keep doing that. There is no challenge on that.
So, with respect to price hikes, given that we are in an inflationary scenario and all, So what do you see, how are peers performing in this area? Are they able to take price hikes as well as you, or is there a gap?
No, so you are rightly said there is sometimes customer is pressurizing not to increase the price due to their costs will also increase abruptly, like various costs. So that's why we are also very cautious and don't want to be unnecessarily pressure customers. So wherever is possible, and we seeing various aspects their business volume and which sector they are giving the volume, whether they are fulfilling our return loads and also various aspects. After seeing, then we are putting that price hikes.
All right, sir. And so how much revenue is from value-added services for first half FY23?
It is around 16% of overall revenue.
Okay, sir. And my last question was, previously we were of the thought process that we will not increase revenues from e-commerce given that, they're not that profitable. So are we still on the same stance, or is there some changes seen in the sector given that some of the peers have, raised concerns with respect to growth in e-commerce? So what is your perspective on e-commerce as of now?
Our stand is the same. We will not touch it because we know that it is not profitable and it will ruin our B2B business.
All right. Okay. Thank you, sir, for answering all my questions.
Thank you. We'll take our next question from the line of Mayur Parkeria from Wealth Managers India Private Limited. Please go ahead.
Good evening, sir. Am I audible?
Yes.
It looks like Mr. Parkeria's line is disconnected. We'll wait for him to rejoin. In the meanwhile, we'll take our next question. That's from the line of Preet Nagarsheth from Wealth Advisor. Please go ahead.
Good evening, guys. Chandar, one question I wanted to ask you is that you've given quite an update on the Gurgaon sorting center. But one aspect is that have you finished all the complete implementation of it, or is there something remaining on the Gurgaon side?
It's all done. It's all complete. The study is done. Everything is done.
And have you achieved all the goals that you had in mind for it?
All our investors. There's a big group coming to see it. Mukti has the details and they will be coming, so you can join them also.
Okay, would love to. But my question is that have you achieved all the key objectives that you had with that sorting center?
Mukti?
Yeah. So yes, so we, that's why we have taken a long time, because the first time we have launched this automation in B2B industry in India. So we make a lot of studies, and then finally we are able to stabilize everything, August onwards. And so we have done, we have stabilized the process of vehicles movement for the my branch to hub, and then sorting center to sorting center, their timing, everything like labor reduction or labor, optimization we had done. We are also put a weighing scale there, so now we have a kind of weight management also we have done. So everything, I think whatever, we have put a, component to be made there, we have list out, and then everything has been achieved now.
Right. The reason I was asking is that this basically was your test.
Established our ESG goals with this. It is 100% solar proof. Solar lit. It has got now we're getting that also the green certificate for it. So it's like one of the most important sorting centers that has come up, and we will make 10 of these like that.
Okay, that's great. So, Chandra, the reason I was setting this up was because basically this means that this was your first launch on.
I can't hear you. Can you speak a little louder?
I'm sorry. Can you hear me? Is it better?
A little better, yes.
Hello? Yeah, okay. So now that all your SOPs are in place and all the learnings are in place, would you say that the next center that you're building for Pune, you would be able to achieve what you did with Gurgaon in much lesser time frame?
What will be, sorry?
Whatever you're looking to achieve in Pune, you will be able to achieve it in lesser time frame than what you did with Gurgaon?
No, because it's not Gurgaon, it's Pune. It has its own challenges. It has its own micro and macro environment. So everything is very, our country is very dynamic. So East is different, West is different, North is different, Central is different.
Sure. Okay. Chandra, any insight on the C2C and the Rail Express? How the traction on these two?
No, B2C is average. There's nothing we are doing in that. There are better companies than us in B2C who are doing. And Rail Express is doing very well for us.
I meant C2C. Like, how are we doing with the C2C side?
Mukti?
Yeah. So C2C, yes, it is again a niche segment and we are doing well. And this business is increasing, like if you talk about in this quarter, so it is increasing around 14%. And this is growing well. And it is also like giving the similar kind of margin to us.
Okay. And what about Rail Express? Is the traction growing? Have you started new routes as you were planning to?
Yeah. So we have actually given the update in our earning presentations also. So that route has increased, number of customers has increased. Now repetitive customers, various number of customers are repetitive now in the nature. So they, again and again using this service. So this is getting attraction and is going fantastically well.
Wonderful. Great. Thank you, guys.
Thank you.
Thank you. We'll take a next question from the line of Ash Shah from Elara Capital. Please go ahead.
Hi, good evening and congratulations for a great set of numbers. So first question was that, Chandra sir, you had mentioned that we have added 22 branches in this quarter. So how many branches are we planning to add in FY23 and 24? Also, if you could provide any particular geography that we are concentrating on.
Yeah. So basically, in this half year, we added almost 22 branches, and majorly one in, north and west. Majorly one in the west and then north. And remaining 6 months, we are planning to be open in the range. Numbers are around 50 number we want to be open. And in FY24, again, it is 100. We want to open 100 numbers. So basically, we expanding wherever we, before opening up any branches, we, do the study there, whether is a viable solution or is a really, and another aspect to see, we have to see it has to be on a particular route where our existing truck is going on. So additional cost should not be increased on, to carry the material from that branch to my sorting center and vice versa. So these various aspects we're saying and then, opening up the branches.
So basically, we are going to add 72 branches in FY23, which is lower than 100 that we were targeting. So any reason for the deviation or something?
So no, nothing is, it's a usual thing. We became making the study and then opening up. Sometimes is not possible, sometimes it's possible, yeah.
Okay. Next on, can you just give us the contribution of retail, SMEs and large accounts for this particular quarter, and what are the targets that we are planning to achieve on that front?
Yeah. So basically, in this quarter particularly, it is a 52 to 48% ratio. 52% is from SME and 48 from the big customers. And for the whole this half year, it is around 51% and 49%. So always our endeavor to be maintained to 50%, though it is very easy to increase the business from the big customer because they're giving the big volumes. But we have to be, balance out the both things to maintain our margin level and fulfill factor in my trucks. So that's why we are taking in a very balanced approach always.
Okay. And last question. After this Gurgaon center, we are planning to build a Kolkata center. So how long will that take? I mean, I think the land acquisition has been completed. And could you give the timelines for the other sorting centers also, like Nagpur, Chennai, and Mumbai?
So before Kolkata, because Kolkata we just bought the land, it will take the time to start the construction because eastern sector still has the more challenges than other part of India for approval and everything. So first, Chennai will be first come to that, and then subsequently Kolkata will become, and then Mumbai, Ahmedabad, and Nagpur will become.
Okay, so Chennai will come in FY23 or FY24?
It will be mid of next year, FY24.
Okay. Thank you so much, sir.
Thank you.
Thank you. Our next question is from the line of Mayur Parkeria from Wealth Managers India Private Limited. Please go ahead.
Sir, thank you again for taking my questions. I got disconnected. Sir, on the Gurgaon center, actually, when I joined, there was a question already going on, so I may have missed a part of it. I had the question on the same side. The parameters which you must have set earlier, some of the benchmarks and milestones, is there any major changes in which, where, your expectations have not been met as per what you had earlier anticipated in terms of either efficiency or, in terms of cost structure? Just as an experience.
So not really, but we are facing challenge on Mayur, because this is a vice versa also, like we sending the truck to my other destination, there they do not have any automation. So sometimes they get delayed the things to, unload and load the things. So subsequently this truck will be also then reach the late. So we are, putting a parameter ki what time they should be reach and must be carrying the priority there on these centers, so it reach back to my this center back. So these challenges we just facing and putting some strict SOP to fulfill by all the other centers basically. That's the, I think, challenge we have. Otherwise, so we already met the all parameters and is running very smooth.
Okay, great. Sir, I know it may be a little directional statement, but just to, we want to get a little more clarity on that. FY25, we said around 2,000 plus crore turnover is our target. We are at a 1,200 crore run rate on the annual basis. You said FY24 we can still target 20%, but the ask rate then for FY25 would be substantially higher at 40%. Is that a correct way to read, or because from 1,200 crore to 2,000 is a 30% plus ask rate, whereas for FY24 if we are at only 18-20%, then FY25 ask rate will be much higher. Is it because more centers will come up, or is there a directional just a clarification there, sir?
Yeah, so basically, if you see, Mayur, this is not the correct thing, what you're saying. In this year, this run rate in this quarter was 310 crore rupees, and next 6 months we'll be getting around 675 crore kind of revenue will be get in next 2 quarters. If you see the trend, we have the Q4 is the highest revenue quarter, so we are targeting
right.
At least have 1,275 crore or 1,300 crore rupees revenue. And then subsequently that rate will be get reduced 20% in next year, then it will become 1,600 crore, and then obviously 20-25% will become 2,000 crore rupees. And why we are saying, because we are ready for the next growth levels. Like we have launched the services in last year only, and they are maturing now. We are finding new customer. We already put the different independent team to get businesses in these new streams or new services we have launched, like rail, C2C, and cold chain pharma. And we are also adding up the branches. Now this automation is also obviously help us to get the customers good customers experience on that. So if you put together all things, we are on the right path obviously, and apart that we also will be take the price hikes also from customers. Supposing in next year inflation is not so high, so we will be able to take slightly more price hike from the customer. So all depends. But yes, we sincerely making the effort to become a 2,000 crore company by 2025 with the EBITDA margin level of 20%.
Yeah, it's great. Great, sir. Wish you all the best for that. So I had just one last question for Mr. Agarwal, a little strategic question from a broader term. Sir, we have increased our total services. Now, if we look at whether it's normal B2B express, C2C now added, rail added, cold chain added, rail. So the segments are more and more segments are increasing. So from a management perspective, do you think that it will be, from a customer standpoint, is it an integrated service offering, and hence there is no need to add, segment or SBU level president kind of or senior management, or do you think that at some point of time we will have to require key heads to lead each vertical, because they will have an independent offering and need to be driven independently. From a structure perspective, how do you foresee as the scale is also improving, sir?
You got that right. As the business volume and the business itself grows, then there will be definitely, like an independent head running that business.
Okay, sir. And do you see that foreseeing in the next 2 years, or will it be faster or later?
See, we are not the kind of company that will just add manpower just for the sake of adding. So we will see how the business grows, and then we will do it.
Okay, sir. Thank you so much, and wish you all the best. Thank you.
Thank you. Our next question is from the line of Sumit Jain from ASK Investment Managers. Please go ahead.
Hello, sir. Just wanted to know what is the margin differential between our SME business and large corporates?
Yeah. So it is actually significant differences there, like in retail, and if you talk about big customers, so it is almost in a gap of 25 to 30% in general sense, I am saying. Though, because again, depending on sector to sector, segment wise, like always engineering goods is giving higher margin in comparison to retail business. So various dynamic factors also there, but in general sense, yes, it is almost 25 to 30% difference is there.
Okay. And when you said 58% is the mix, this is by volume or by value?
I said it's 52%.
52% by value?
Yes.
Sure. Okay. Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the floor back to the management for closing comments. Over to you, sir.
I thank you all for participating in tonight's event, and we are really excited about the opportunity that awaits us in the next half of the year, of the financial year, and I look forward to speaking to everyone again accordingly. Thank you very much, and have a pleasant evening.
Thank you, everyone.
Thank you, members of the management. On behalf of PhillipCapital India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your